Good morning, good afternoon, good evening, wherever you are. I'm your host, FD for SageFact.tv, and in this latest video, let's talk about the backstage stars of crypto, that is, crypto market makers, and why they make or break your trade. Think of them as friendly tunnels under a crowded street. They quietly lend you passage, and if you don't recognize them, you'll keep getting stuck in traffic. Here is a deep dive into who they are, what drives them, and how they interact with the crowd, and how you, the retail trader, can spot them and avoid walking into a trapdoor. But before I jump into this, guys, please note that I am not a financial advisor. I'm just some dude on the internet interested in everything crypto, including market makers, how our market is shaped by the powers behind the scenes, the dark forces, if you want to call them. Please do your own research. I'm not a financial advisor, and this content is also not targeting UK audiences for obvious reasons, obviously, and I have no expertise in what I'm about to share with you here. These are just my own opinions, uninformed opinions, if you want to call them that. But I hope you can learn one or two things. So who are the current crypto market makers? I'm talking of actual, not abstract, but actual. And these firms are the lifeblood of liquidity within the crypto ecosystem. Let's start with GSR Market, a veteran liquidity provider across dozens of centralized exchanges and DeFi platforms. Next, you got DWF Labs, a VC-backed firm combining capital, high-frequency trading, and advisory services. Next, you got Wintermute. I think this is widely acknowledged as a market maker, and I think they work with the likes of Binance and many other exchanges. Wintermute is active on centralized exchanges and DEXs, algorithm trading, recently expanding to New York post-US regulatory shift. B2C2, London-based, SBI-owned, servicing spot and derivative liquidity, currently raising capital, approximately 200 million. Next, you got Vortex, Ember Group, Empirica, Chiron Labs, Bitquartz, Algos, all powering liquidity across new launches and emerging tokens. And finally, you've got Efficient Frontier and Cumberland, linked to DRW, handling institutional OTC or over-the-counter trading and liquidity making. These players make markets smoother for both retail and institutional users, but there is always a but. So how do they actually operate? Well, they place simultaneous bids and asks to tighten spreads and provide liquidity. This makes them order book makers. You also have market makers borrowing tokens from projects to supply liquidity, repaying tokens later, aligning incentives with long-term token performance. And this is also known as loan versus retainer models, for example, DWF Labs. Next, you got hybrid models where the fee plus spread or performance-based contracts are tied to liquidity benchmarks, often bundled with advisory services during token launches. And finally, you've got algorithmic and high-frequency trading, where market makers respond to order flows in milliseconds across exchanges to maintain tight spreads and depth. So in essence, they profit from spread and volume while stabilizing prices and smoothing volatility. So you could say they are a necessary evil under certain circumstances or in certain situations. Moving on to the psychology, what actually drives them? The first thing is that they are resilient to volatility. They do not possess emotional attachment, which is key. They are trading machines, managing risks, and not gamblers. They also master market psychology. They anticipate head moves, absorb retail panic, dampen checkpoints while staying nimble. Long-term incentive alignment is something that also drives them. With loan-based model setups, they benefit from token appreciation, not dumping quickly. So if they are pumping a coin or token, they are patient. You might think you have won, but they may also end up making you feel like you are missing out through FOMO. Why? Because you sold when you thought you made your 2-3x, but the price keeps pumping up. The key for me, how I normally handle this is when they are pumping a token like that, I'll sell, keep my money until the price drops to where it was or well below that. It depends, but if it's a raging bull market, it might not come back to exactly where it was. In other circumstances, if I'm just sold and I'm relieved that I'm out of that position, I'm switch my resources somewhere else. That's just me. I don't know how you handle that. Moving on to the dynamics of market makers versus market players. Let's start with retail traders who encounter them in tight spreads and low slippage. But beware, when sentiment shifts, market makers pull liquidity quite swiftly. You will be left with a long red candle and no liquidity, which means loss in most cases. Token issuers deploy them to seed early liquidity, stabilize price action post-launch, and shape sentiment. Institutions also rely on market makers for large fields, for example, OTC trades and priced transparency. DEX protocols benefit from market maker provided liquidity to reduce slippage and encourage volume, but there is also a price where they extract the small pound of flesh. Market makers smooth volatility, but in extreme cases, they strategically reduce exposure when the retail FOMO turns into wet buys. How to spot a market maker at work? Sometimes it's not obvious, and they don't always show, okay? But you can spot a market maker at work. Tight bid-ask spreads across venues, especially on new or mid-cap tokens. You can see big buying price lining up, but when they're selling very tiny amounts. That's a market maker trying to push the price up. That happens. Consistent depth in order books even when retail volumes are low, liquidity presence across multiple exchanges with similar price layers, behavior during volatility, ghosts when prices collapse, returns when calm returns. Tools like CoinWatch track now let token issuers monitor real-time market maker activity, for example, GSR, Ember, IMC, and Kiro. If you see organized liquidity, narrow threads, machine-like adjustments, that is the handwork of a market maker. Now, how should you behave as a retail investor around market makers? It's quite important how you react. Don't chase price action on thinly pooled liquidity. Market makers may be pulling up. Recognize support likely from them. Price bounds around bid zones may reflect their depth, not fundamental interest. Scale into trades. Don't assume their liquidity means sustainable demand. Observe their behavior. When spreads widen, depth evaporates. That's your cue. Take caution or exit. Use breakout volume confirmations, not liquidity gaps, as entry signals. Think of them as the ocean tide. Know when high and respect the receding phase. The other thing as well to probably second guess whether a market maker is at play or not is when there is high trading taking place. How do you sense or identify that? When the volume far exceeds the market cap. Usually that's a market maker at play. They're trading it like crazy. End up seeing a token or a small cap token or mid cap token with a market cap of say 100 million US dollars, but its volume is 1.2 billion. Something is not adding up. That is a market maker at play. Retail investors just looking at the shape of a chart, they are looking at that being tricked into thinking that this chart has got a long way to go. But if you look at that metric, volume versus market cap, it will tell you a deeper story in a million words, if you know how to read those million words, that is. Anyway, guys, my final thoughts on what I think about who is running the show most of the time within crypto. I think crypto market makers are the invisible puppeteers stabilizing the show, but they are not the performers. They don't care whether retail wins or loses. They care that trades flow, trades persist, and markets remain oddly enough to trade again tomorrow. Who wins in such cases? Well, retail traders who respect these liquidity giants don't fight the flow, they safe it smartly. They spot them, learn their patterns, then trade around, not against their rhythm. In short, market makers keep the lights on. Retail traders should learn to read their signals rather than follow their shadows. So what are you doing? Are you watching out for market makers? Let us know in the comment section. If you ever benefited or lost money on market makers or versus market makers, let us know in the comment section. It's not easy to read whether a market maker is a play or not, but it's quite possible. Anyway, guys, that's it from your host, FD for City5.tv. Signing out for now. Bye.